This is the question I get at least twice a week. Should I refinance, and is now the right time? After 30 years of this here in Palm Beach Gardens, here's what I know. The right time to refinance is not a date on the calendar. It is the moment the new loan puts you in a clearly better spot than the one you have now. So let me give you the 4 reasons that actually justify a refinance and 2 situations where the smaller move is the smarter one. First, to improve your rate and term. If you can lower your interest rate or move to a shorter term, a refinance can lower your monthly payment or help you pay the loan off faster. The number to watch is the break-even point. Add up the cost of the refinance, then count how many months of savings it takes to earn that cost back. If you plan to stay in the home past that point, the math usually works. Reason 2, to get rid of mortgage insurance. And here's where I'm going to save some of you some money. On a conventional loan, you often do not need to refinance to drop private mortgage insurance. Once you have enough equity, you can request that it be removed, and by law it comes off at a certain point. So check that first. FHA loans are a different story. On most FHA loans, the mortgage insurance stays for the life of the loan. It does not fall off on its own. The usual way to get rid of it is to refinance out of the FHA loan into a conventional loan once you have the equity. For a lot of homeowners, that one move is the whole reason to refinance. Reason 3, to consolidate high interest debt. If you're carrying high interest credit card balances, a cash out refinance can roll that debt into your mortgage at a lower rate and free up your monthly cash flow. Now, here's the honest part. This can be a smart or a costly move depending on your situation, so this is one to walk through carefully with someone who will tell you the truth. Reason 4, to pay for renovations. If your home needs work, a cash-out refinance lets you use your equity to fund. Down in South Florida, that often means impact windows, a new roof, storm upgrades, along with the usual kitchens and baths. Using your equity to add value back to your home can make real sense. Now, the 2 situations where you might not want a full refinance at all, the first is a home equity line of credit. A full refinance replaces your entire mortgage. A home equity line of credit leaves your current mortgage in place and adds a separate line on top of it. So if you have a great rate and you only need some cash, refinancing the whole mortgage means giving up that rate on your entire balance. A home equity line of credit lets you tap your equity without touching the first mortgage. We do both, so the conversation is about what fits you, not what we're trying to sell. And second, if you're self-employed, a 1099 contractor, or a real estate investor, a traditional refinance can be frustrating because your tax returns may not show your full income. There are programs built for this. A bank statement refinance looks at your deposits. A DSCR refinance for investors looks at the property income. And if the bank told you no, it may just mean you were talking to the wrong lender. If you want us to run your actual numbers and tell you whether a refinance even makes sense for you, the calendar link is in the description. You bring the questions, we'll bring the answers.